Hi everyone, it's Steve, and we're going to be looking now at the final problem homework, final non-paper homework that you'll have for the quarter. And this one we're going to be dealing with long-term liabilities. And the chapter focuses mainly on bonds, and that's also what the homework is going to focus on, and that's what this little homework starter is going to talk about. First of all, what are bonds? Bonds are debt issued by either a business, could be a municipality, could be a town, debt issued by, sort of by them, essentially an IOU to someone who purchases that debt with the knowledge that they're going to pay a certain interest rate over a certain time period. For folks, for a business, they might need money for, expanding operations, or maybe a bunch of new equipment, something like that, so they may issue a bond. Whereas a municipality, a town, let's say Bellingham School Districts needs some buses, right? So they issue a bond in order to raise money. That's what issuing a bond does. So you, the bond issuer, you're issuing this bond to get an initial influx of cash. And what happens then is you issue this bond, again, at a certain interest rate over a certain period of time. And the person who purchases the bond will receive, each year, they will receive the interest rate that you give on your bond. On that amount, they receive interest each year, but you don't have to pay back the face value until the end. And that in that way, bonds are different than, like, say, like a car loan or a home loan. Whereas a home loan, you think about if somebody owns a car, if you owns a home, or if you've purchased a car, part of your payment over time goes to principal, part goes to interest. With a bond, it's completely different. Each year, let's say it's a 10-year bond, each year of those 10 years, the person who sold the bond, who issued the bond, they only pay the interest each year, and whatever the interest rate is on that bond is what they pay. And then at the end of the 10 years, if it's a 10-year bond, that's when they pay the entirety of it back. And I have 3 examples here I'll show you that will hopefully make that a little bit clearer. First, we're going to be looking at, because we also have to deal with premiums and discounts. And that's a big crux of the chapter, and it's a concept that can be hard to wrap your head around. So we really want to focus on that in the chapter and for the homework. But first, we're just going to look at a bond that is issued at market rate. That is just like market rate is be like, why would it, sort of in a hypothetical situation, every bond that a purchaser could buy 10%. That's what the market is. That's what the going market rate is. And we're going to be issuing our bond at that rate. So let's pop over here to the spreadsheet. So here in this first example, we have one. We're going to talk about premium and discount in a second. But if we have a market rate of 10% and our bond interest rate is also 10%, that means that there is no discount, there is no premium. But because in each of these examples, the bond that we're issuing is a 10-year, $50,000 bond. So that means at the end of the 10 years, we're going to owe somebody $50,000, and each year that passes, we're going to owe them some percentage in interest. And so what happens is, let's just kind of look at how that shakes out. So we have the market rate is 10%, and we are also issuing at 10%. So there is no discount, there is no premium. And what that means is we're going to get face value. We want to get $50,000 for these bonds. The face value is $50,000 bond, and that's what we're going to get. So we're selling this $50,000 bond for $50,000. That's what we receive. And we receive that, we're the issuer, the person selling the bond. We receive that up front when the bond is issued. Now, each year of the 10 years, again, this is a $50,000 10-year bond. Each year, at the end of the year, or possibly 2 times a year, it's maybe it's split up in the middle, but we're going to use a yearly example here. Each year that the bond is is an issuance as the 10 years goes along, into year one, into year two, et cetera, we're going to have to pay whatever our interest rate is on that amount to the purchaser of the bond. So every year after we've gotten our 50 grand, every year for 10 years, we're going to give them $5,000 a year in interest. And then at the end of and this is using the straight line method, and at the end of the 10 years, we pay back the face value. So if you say that the person who purchased the bond, they're going to get $5,000 a year for 10 years, and they're going to get their initial investment back of the 50 grand. Their total bond return is $100,000. $50,000 a year for 10 years is $50,000. You get your $50,000 back. Your return, is $100,000. Again, this is with no premium and no discount. And now let's look at how that would be journalized. Okay, it's a pretty straightforward process. Here it is. Make this a little bit bigger for all of these. There we go. So here I've just copied and pasted the information from before. It's the market rate is 10%. We issue at 10%. We get face value because it's market rate. Hey, we'll get we'll get what we're selling for. Every year is $5,000, and at the end we have to pay back the $50,000 total bond return. So this is the journal entry from the issuer's perspective. When they get that initial, they sell the bond, they get the initial $50,000, this is the entry for that. They receive $50,000 and it becomes a bond payable. It's just talking about long-term liabilities here. It becomes a bond payable. Think about, like from accounting, early accounting, a kind of a accounts payable. Very similar to that, but here we're talking more long-term. So we get our cash, hooray, hooray. Now we can, buy our school buses, or we can expand our operation, whatever we wanted to do. But we know that here in 10 years, again, because it's a 10-year bond, bonds are typically, in increments like 5, 10, 20, sometimes 30 years. Municipalities typically, or not typically, but often people do 30-year bonds for large projects. So anyway, so we get our 50 grand, and we know that in 10 years, we're going to owe these people 50 grand, right? Because it's, that's what we've signed up for. Each year, I've only put one of them here, but each year for 10 years, we would have an interest expense, because we're paying 10% on that 10% on that bond. We'd have an interest expense of $5,000, and we would pay cash to the person who purchased it of $5,000. Okay, so it's the interest expense every year. And then, at the end of the 10 years, we would then pay back the initial principal. So we would, debit the payable to make it sort of get off the books, and we would use the cash to pay our debt, right? So that's a fairly straightforward process. You would have, here's your issuance. You do 10 of these along the way because you have to pay 10 times. And then at the very end of the whole shebang, you pay it off. And hopefully that investment has paid off, and your new equipment has paid off 10 times this, and it was a great investment for everybody, and everybody walks away happy, right? Great. Okay, now we're going to look at the situation in case of a bond that we sell at a premium. And this is really important to remember, because if you sell at a premium or a discount, that's going to affect your interest costs over the life of the bond. So here in this case, we'd have an interest expense of $50,000 because you'd have $50,000 10 times. So let's go back here and look then at a premium. I'm just going to look at this one right here. The discount will come up in a moment. So in this case, the market rate is 10%, right? And keep in mind, this market rate isn't going to affect our calculations at all. It just affects what we can get for our bond, right? It's just knowing that will let us know, depending on how much interest we're getting, whether we can sell it at a discount, a premium, or just at the market rate, and get kind of face value for that. So here in this case, the market rate, or in the bond market, is 10%, right? In this case, however, we are offering our bond at 12%. And this is going to be very attractive for a buyer because They know that they're going to be getting more money every year for the interest, right? And you say the difference between 10%, 12%, oh, it's just 2%. But if we're talking about, a huge bond, $1 million bond, that's a lot of money, right? Again, and you're getting this every year for 10 years. So in this case, again, our bond is issued at $50,000, right? So we're going to owe $50,000 at the end of 10 years. However, like we said, instead of giving 10% each year, we're going to be giving 12%. So again, it's going to be attractive to investors. So in this case, we may be able to sell that bond for more than the face value. In this case, in this example, we were able to get, instead of $50,000, we're going to get $55,000 because this bond is so attractive to investors, because there's going to be more interest coming in, they'd be willing to pay more. Maybe you can get a little bit of competition, a bidding war going on, right? And so, who knows? But this is the example, right? And so in this case, we were able to find a person who purchased this at $55,000. So we got $5,000 more than we were asking for in the case where we gave just market rate. Now, the downside of this for the company, of course, is they're going to have to pay more in interest over the course of the 10 years, but they're going to get a little bit more money up front, right? Maybe this is the case where the business doesn't have a great reputation. Maybe they have to, offer higher rates, right? So maybe they don't get the premium at all. Maybe they just get face value. But in this case, it is an opportunity for the company to get a little bit more than the face value of the bond. Again, all of these bonds in each example is just $50,000, but here we get 55. So because we have 12% interest, we're going to be paying a little bit more each year. In this case, 12% of $50,000 is $6,000. We'll do that over the course of 10 years. And so each year you're paying $6,000 instead of $5,000. At the end of the 10 years, again, you've issued the bond. It's a $50,000 bond. That's all you're paying back. You don't pay back $55,000. The $5,000 is simply the premium. At the end of the 10 years, you pay back $50,000. But over the course of the bond, you've also paid, way more in interest, and so the total bond return is $110,000 for the person who purchased it. Where up here, the total bond return was $100,000. So here, they end up making essentially $5,000 more because they paid $5,000 for the privilege of this higher rate, but they ended up with $10,000 more in interest. You offset that there. You're looking at a $5,000 increase in return. So it's attractive for the investor. So let's look at how that affects the journal entries, again, from the issuing company's perspective. Before I pop over there, we got to think about things, is that we're looking at how this is going to affect our interest expense. And because we received more than we asked for, you can kind of think of it as this premium is then going to offset a portion of this interest as we pay it off. And that's what we do. So typically, we'll amortize it over the course. So we'll take a portion of the premium that will affect the interest each of the 10 years, or each of the years that the bond is issued. Again, we're using the straight line method here, and nothing about carrying value, all of that. But then let's look then and see how that affects the journal entries. And so here, let me make this bigger again. And again, same value. The market rate was 10. We issued for 12, so we got a premium. We got 5,000 premium, but we have to pay more interest every year. And so now, when we get that initial influx of cash, we get the 55,000. Our bonds payable, though, is still just 50,000 because that's how much the face value is. That's how much we're going to owe. And so we're left with the extra $5,000. And we do that in its a liability account, and it's called premium on bonds payable. And we put our 5 grand of premium right there. And then, just like the other, just like here, but we didn't have the premium, our interest expense, 5,000, cash 5,000. In this case, interest expense, 6,000, cash 6,000, because again, higher rate, every year we're going to pay a little bit more. But this is where the amortization of that premium comes in. So basically what we're going to do, we probably already spent that cash, but what we're going to do is this premium that we got is we're going to, from an accounting perspective, offset that interest expense. We're going to amortize it over the course of the bond. And so in this case, we have premium 10 years, break this up into 10 equal pieces. So the premium on bonds payable is 500, and then it offsets or reduces our interest expense here $500 because we got the extra money up front. We amortize it or spread it out over the course of the bond. So basically, what we're saying here is that instead of saying 5,000 up front, we're saying, or we are saying 5,000 up front, then we're spreading the wealth of that out over the 10 years as 500 pop. And then at the end of the period, bonds payable, 50 grand, cash, 50 grand, because it was the face value of the bond was a $50,000 bond, but because of the interest disparity, we have a little bit more work to do. And again, good times, right? I mean, we got more cash up front, investor got more money in interest. Hey, everybody's happy. Now let's look at the opposite situation, is when you have a bond that is discounted. Could be any number of reasons for this, whatever. Here we have a market rate of 10%, but we're issuing, again, our 50,000 10-year bond at 8%. So this makes the bond less attractive in the market. Why would an investor take our bond at 8% when they could get 10% over here, right? It's just very simple. They wouldn't. So in this case, we may be faced with selling it at a discount. And what that means is we get less upfront because the investor is going to get less in interest over the course of the bond. And so just like with the others, in this case, we have our market rate of 10%, but we're giving a little bit less, Again, we say 2%, but if we're talking about a huge bond, it could be a whole lot of money. So in this case, we have a face value of $50,000. We're going to have to pay back $50,000, but in this case, we sell it at 45 because we're offering a lower interest rate. And so what that means, of course, is that each year the investor will get less than both, whether we, no discount or premium or premiums right here, instead of getting 5,000 or 6,000 because we're 2% less, now they're only getting $4,000 per year instead of, the market rate, which would be 10%. And so what that means is we do have to pay back, even though we only got $45,000 for it, we have to pay back $50,000. It's a $50,000 bond. We're paying back $50,000, no matter what we get. So here we've got 45 that we received, and we've got to pay, 50. And we pay $4,000 in interest, and then here the total bond return is 90,000. So again, the investor is going to end up getting less, so they're going to pay less, right? Makes sense. And then, but let's look at how that then is affected, how that affects the company issuer's journal entries. Make these bigger. And so let's take a look. And again, this is just go over it one more time. Market rate was 10, we give 8, so we're unable to get the full 50 grand, so we were able to get 45. We pay $4,000 per year in interest. At the end of the 10 years, we pay 50,000. And so we see here where in the premium, we got a little bit extra here, we get a little bit less, and then this will be what's known as a discount on bonds payable. Put that in discount on bonds payable account. And just like with a premium, we're going to amortize this over the course of the 10 years. So in this case, just like all three, you have your interest expense. You still have to pay the interest every year. In this case, though, you're going to amortize the discount, and that's going to create a situation where each year you're going to have an increase because because of all of this is the entirety of it is going to end up being an interest cost. So you amortize it to increase your interest expense over the life of the bond. So if you have a premium, you're discounting, or you're reducing the, I shouldn't say premium and discount together. If you have a premium, you're reducing the amount of interest expense that you have over the course of the bond. If you have a discount, you are increasing the amount of interest expense over the course of the bond because of this amortization. You're going to pay $5,000 more in interest costs because, oops, I got my mouse off the floor, or onto the floor, and yeah, so it's spread out over the course. And then at the end of the 10 years, your entry is bonds payable dash 50 grand, right? And so this is going to that overview is really going to or should at least, guide how you do your homework. Just kind of the concept is that a premium, you're going to end up paying less in interest because you got extra money. It's going to offset that. In a discount, you're going to pay more in interest because you got less money, and so therefore you're going to have to pony up more for interest to cover the discount. And so this will affect, because you're going to be doing some journal entries. I think it's mostly just paying out. You're sort of receiving the money and then doing a little payouts. I don't think you ever have to do the payback in the homework, but if you do, that's how you do it. And then I believe the first two are just doing some calculations. So just remember that, premium decreases interest. You have to keep that in mind. And a discount increases interest expense. And I believe that kind of covers it. Of course, again, if you have any questions, please let me know. Other than that, now, if you have papers to do, good luck with them. If you have questions about those, please let me know too. I'm not going to be making a video for those. It's just, a paper. All right. I hope everybody has a great day or evening, whatever it is, and we'll talk to you soon.